Welcome to The Explainer. Today, we're doing something a little different. We're not just going to look at numbers, we're going to crack some codes. We're about to turn financial analysis, something that can feel, well, a little dry, into a full-blown detective game.
Okay, so let's just dive right in with a question. It sounds kind of impossible, right? An airline versus a grocery store? But I promise you, by the end of our time here, you'll see exactly how a few key numbers, just a handful, can tell you a company's entire story. We're talking their strategy, their customers, the whole deal.
So the first thing we have to do is kind of shift our mindset. Forget about being accountants today. Nope. Today, we're detectives. And our mission is to figure out who these companies are with nothing but a few financial clues.
And the book this is based on frames it perfectly. This is not about memorizing a bunch of boring formulas. It's a game designed to build that financial intuition. You could almost think of it like a financial escape room. Pretty cool, huh? All right, here it is. Our crime scene, if you will. This is a table of real, you definitely know them companies, but they've all been stripped of their names. All we've got is their financial DNA, and it's laid out using three key clues: profit margin, asset turnover, and leverage. So the challenge is simple. Can we figure out who is who?
Okay, but before any good detective starts investigating, they need their toolkit, right? So let's put ours together really quick. We just need to get a handle on three crucial clues that are going to help us solve this whole thing. First up is profitability. And really, this is all about one thing: value creation. Think about it. A company like Intel has crazy high profitability. Why? Because they take something simple like sand and turn it into these incredibly complex computer chips. That's a massive value add. Then you've got a grocery store. They sell a box of cereal and their margins are razor thin. So just remember, high profitability equals high value add.
All right, next tool, asset turnover. So that grocery store we just talked about, the one with the tiny profits on each item, well, it has a different superpower. And that superpower is speed. It sells its entire inventory, then does it again and again and again, super quickly. That's what high asset turnover is. It's not a game of profit, it's a game of pure volume.
And our last tool in the kit is leverage. Look, in simple terms, it's just about using debt. Think of a physical lever, right? It lets you multiply your force so you can move this giant rock you couldn't budge on your own. Well, financial leverage does the exact same thing for your returns. But here's the catch. It also multiplies your risk. Seriously, entire empires have been built and completely destroyed with this one tool. And this really shows you how it works in the real world. A bank, it's a high leverage business by its very nature. It takes our deposits, which, let's be honest, are just loans we make to the bank, and uses them to make its own loans. But then you have a high-risk tech company. It's already dealing with so much business risk. Will this new gadget sell? It just can't afford to pile on a ton of financial risk from debt on top of that.
All right, detective, our toolkit is ready to go. So let's head back to that mystery table and get this investigation started. It's time to find our first clue.
Okay, so we're looking at the asset side of the balance sheet now for a few of our mystery companies. Stuff like their cash, what their customers owe them, their actual physical inventory, all that good stuff. And I get it. At first glance, it's just a wall of numbers. But here's the secret. You don't look at everything. You look for one specific thing.
So what is that thing? Well, here's maybe the most important takeaway from this whole explainer. The best first step in any financial analysis is to look for the extremes. Don't worry about the averages, look for the weird stuff, the outliers. So, take a look. Scan these rows. Do any of these numbers just jump right off the page at you? What's the weirdest, most interesting number on this whole slide? It's 0. Look at that inventories row. A bunch of these companies have 0.0% inventory. Absolutely nothing. Now that is a massive clue.
So what in the world does zero inventory tell us? Well, think about it. If a company has no physical stuff to sell, it has to be a service business, right? It's not selling you a thing, it's selling you a service. And just like that, boom, we'd pulled our service companies, the airline, the bank, the logistics company, right out from the rest of the pack. But okay, that just leads us to the next puzzle, doesn't it? We've got this little group of service companies, but how on earth do we tell them apart? How do we know which one's the airline, which one's the bank, and which one is the logistics provider? We need another clue. Let's see where this goes. Well, we can look at how fast they get paid. It's something called the collection period. Just think about Southwest Airlines for a second.
They sell tickets to us, you and me, and we pay, what, instantly with a credit card. Okay, now think about a company like UPS. They sell their services to other big businesses, and those companies might take 30, 60, hey, maybe even 90 days to finally pay their bills. So a really short collection period, that screams consumer business. A long one, that tells you it's probably a business-to-business model.
So if we use the same logic, looking for extremes like zero inventory and super fast payments, we could actually identify every single company on that list. The one with no inventory and you pay them instantly, that's got to be our airline. The one with tiny profits but sells stuff like crazy, that's our grocery store. See how it works? But honestly, the real goal here isn't just about winning the game. It's about learning the method. It's about learning how to see the story that's hiding behind the numbers.
And this is the key takeaway, for sure. You now have a simple 3-step method you can use to analyze pretty much any company you want. Step 1, look for the extremes, the outliers. Step 2, create a story about it. Ask yourself, okay, what kind of business would actually operate like this? And step 3, find another data point to see if your story holds up to confirm your hypothesis. Because at the end of the day, these numbers, they aren't just abstract data points on a spreadsheet. They are a language. It's the language a business uses to tell you its story, its strategy, its reality. And the really great news, you now know the basics of how to translate it. But hang on, before we finish up, our detective story has one final crucial twist. So we've learned how to read the story in the numbers, but there's a really important lesson about which numbers tell the truest story. And it all comes down to the difference between accounting profit and the cold, hard reality of cash. The CFO of Heineken had this brilliant quote. He said, "Revenue is vanity, result is sanity, and cash is king." I love that. Let's look at a really stunning, real-world example of what he means. Let's talk about Amazon. Okay, so if you had looked at Amazon's official income statement back in 2014, this is what you would have seen. A net loss of $241 million. I mean, on paper, it looks like they were just hemorrhaging money, right? A huge loss. But then, if you look at a different number, something called EBITDA, which is basically a way to measure the actual cash they're generating, they brought in almost $5 billion. Let that sink in. A $241 million loss on one statement, but a $5 billion gain in cash? I mean, how is that even possible? Well, the difference comes down to these huge non-cash expenses, things like the depreciation on their massive warehouses and all their servers. These are basically just accounting entries. They lower the profit number, but no actual cash ever leaves the bank. And this shows us something so important. Reported profit can sometimes be just an opinion, It's shaped by accounting rules. But cash is a fact. So the ultimate question that finance always comes back to is this. After all the accounting is said and done, where's the real story? And the answer is always, always follow the cash.